Hello, and welcome back to Boni's Life, your home for deep, unfiltered analysis of the financial world. As we approach the end of 2025, we're taking a look back at a year that has been nothing short of a roller coaster in the crypto markets. In this special year-end review series, we're dissecting the pivotal moments month by month that have shaped the digital asset landscape. Today, we turn our focus to two of the most dramatic and telling months of the year, September and October. These 2 months were a tale of two vastly different stories. September began with a deceptive calm, a mix of modest gains and quiet consolidation that masked the underlying fragility of the market. October, however, unleashed a storm that will be remembered for years to come, a sudden, violent crash triggered by a single political announcement, a black swan event that exposed the deep-seated vulnerabilities in the crypto ecosystem. We'll break down not just what happened, but why it happened and what it means for you as an investor. We'll explore the technical and fundamental drivers, the global macroeconomic forces at play, and the hard lessons learned. And as always, we'll cut through the noise to give you the kind of in-depth, institutional-grade analysis you won't find anywhere else. So let's begin our journey back to September 2025. The month started with a sense of cautious optimism. After a volatile August, Bitcoin began to show signs of strength, climbing steadily from around $108,000 to a peak of nearly $118,000 in the first half of the month. This was a significant move, a 5% gain that saw Bitcoin outperform many other major assets. However, this strength was not mirrored across the board. Ethereum, which had outperformed Bitcoin in the preceding months of July and August with double-digit gains, took a step back, slipping by about 5%. This divergence between the two crypto giants was an early indicator of the market's uncertainty and the shifting sentiment among institutional investors. While the headline numbers for Bitcoin seemed positive, a closer look at the broader market revealed a more bearish sentiment. Out of the 35 major blockchain tokens that we track, a staggering 23 of them ended the month in the red. This wasn't a broad-based rally, it was a flight to relative safety, with capital flowing into Bitcoin as a safe haven within the crypto space. The Market Vector Smart Contract Leaders Index, a good barometer for the altcoin market, was essentially flat, highlighting the lack of conviction among investors. This pattern is typical of market uncertainty, where traders consolidate into the most liquid and established assets while abandoning riskier positions. From a technical standpoint, September has historically been a challenging month for cryptocurrencies. Since 2016, September has delivered negative returns for the majority of the time, with Bitcoin experiencing negative returns in 62% of September months. Bitcoin, for instance, has an average return of negative 3% in September, while Ethereum's is even worse at negative 7%. So, while Bitcoin's 5% gain in September 2025 bucked the historical trend, the weakness in the altcoin market was very much in line with seasonal patterns. This historical context is crucial for any serious trader. It provides a baseline against which to measure current performance and to temper expectations. Understanding these seasonal dynamics allows sophisticated investors to position themselves ahead of predictable market movements. On the fundamental side, one of the most significant developments in September was the continued growth of digital asset treasuries, or DATs. These are entities like MicroStrategy and BitMine that hold significant amounts of cryptocurrency on their balance sheets. By the end of September, DATs held approximately $135 billion in assets, with MicroStrategy alone accounting for about 53% of this total. This trend of corporate and institutional adoption is a powerful long-term bullish signal for the crypto market, as it provides a steady stream of demand and lends legitimacy to the asset class. However, the sustainability of this trend is a topic of ongoing debate among market analysts, as it is often funded by issuing debt or equity, which can be a risky strategy in a volatile market. The key question is whether these entities can maintain their volatility-driven funding models in periods of reduced market activity. Another key on-chain development in September was the decline in blockchain revenues, which fell by 16% month over month. This was largely a result of reduced market volatility. Lower volatility means fewer arbitrage opportunities for traders, which in turn leads to lower transaction fees paid to the networks. Ethereum's revenue, for example, decreased by 6%, while Solana's fell by 11%. And Tron's experienced a dramatic 37% decline, though Tron's drop was also related to Governance Proposal 104, which more than halved transaction fees. This highlights the reflexive nature of the crypto market, where price action and network fundamentals are tightly intertwined. When volatility drops, so does network activity, which in turn impacts the revenue streams that support blockchain ecosystems. Despite the overall market weakness, there were a few standout performers in September. Mantle, MNT, surged by an impressive 53%, while Avalanche, AVAX, gained 24%. Binance's BNB token also had a strong month, rising by 16%. This outperformance was largely driven by the launch of Asta, a new decentralized perpetual futures exchange on the BNB chain, which quickly gained traction and attracted a significant amount of trading volume, capturing nearly one-third of all blockchain fees. This demonstrates the power of innovation in the crypto space, where a single successful application can drive significant value to its underlying platform. The Asta launch also included incentive farming programs that drove massive volumes, though some analysts questioned the sustainability of these artificially inflated metrics. On the flip side, some of the biggest losers in September were Polygon, POL, which dropped by 19%, and Arbitrum, ARB, which fell by 17%. These are both leading Layer 2 scaling solutions for Ethereum, and their poor performance reflected the broader weakness in the Ethereum ecosystem during the month. Toncoin, TON, also declined by 14%. This underscores the importance of a multifaceted approach to crypto investing, as even the most promising projects can underperform in the short term due to shifting market narratives and capital flows. The Ethereum Layer 2 ecosystem, despite its technical promise, struggled to capture investor attention in September as capital rotated toward other narratives. So if you had invested $100 in Bitcoin at the beginning of September, when the price was around $108,000, you would have ended the month with about $105, a respectable 5% gain. However, if you had invested that same $100 in Ethereum at the beginning of the month, when the price was around $4,000, you would have ended the month with about $95, a 5% loss. This illustrates the importance of asset selection and the divergent performance we saw in September. For traders who understood the seasonal patterns and the flight to safety dynamics, this divergence was entirely predictable and tradable. As September drew to a close, the market was in a state of uneasy equilibrium. Bitcoin had shown resilience, but the broader altcoin market was languishing. The stage was set for a dramatic shift, and that's exactly what we got in October. The deceptive calm of September was shattered, and the market was plunged into a period of extreme volatility and fear. October 2025 will forever be etched in the annals of crypto history as the month of the tariff shock. October started with a bang. Bitcoin, carrying its momentum from September, surged to a new all-time high of over $126,272 in the first week of the month. The market was euphoric. Uptober, as it's often called in the crypto community, seemed to be living up to its name. Social media was flooded with bullish predictions, and leverage in the futures markets reached extreme levels. But this euphoria was short-lived. On October 10th, a day that will live in infamy, the market was rocked by an announcement from former US President Donald Trump. He declared his intention to impose a 100% tariff on all software imports from China, effective November 1st. This announcement came amid rising trade tensions over Chinese rare earth and technology export controls. The reaction was immediate and brutal. Global financial markets went into a tailspin. The S&P 500 had its worst day since April, falling more than 2%, and the global stock market lost an estimated $2 trillion in a single day. But the carnage was most severe in the crypto markets. Bitcoin plummeted from its all-time high, crashing down to around $104,000, a drop of over 17% from its peak. Ethereum fared even worse, falling by over 21% to a low of around $3,700. The speed of the decline was breathtaking, with most of the damage occurring within a few hours of the announcement. This wasn't just a correction, it was a full-blown crash, a liquidation event of historic proportions. Over $19 billion in leveraged long positions were wiped out in the span of about 24 hours. More than 1.6 million traders were liquidated across all exchanges. The speed and ferocity of the crash were breathtaking. It was a stark reminder of the inherent risks of leverage in a market as volatile as crypto. According to data from CoinDesk, more than $16 billion in long positions alone were liquidated, with some platforms reporting even higher total losses when including both long and short positions. The epicenter of this storm was Binance, the world's largest cryptocurrency exchange. At the time, Binance was handling 30 to 40% of global crypto spot and futures volume. As the sell-off intensified, the exchange's infrastructure began to buckle under the pressure. Multiple assets on Binance depegged from their redemption value. The USDE stablecoin, for example, traded at a 35% discount, while WBETH, a wrapped version of staked ETH, momentarily crashed by a staggering 90%. These depegging events created panic among traders who suddenly saw their supposedly stable collateral evaporating. The catalyst for this internal collapse was a massive $90 million market sell order that overwhelmed Binance's internal order books. This also caused its Oracle pricing system to fail, as it was referencing its own distorted prices rather than external sources. The result was a self-reinforcing death spiral. As prices fell on Binance, the Oracle marked down collateral values, triggering more liquidations, which in turn drove prices even lower. To make matters worse, Binance's trading engine seized up for about 100 minutes, preventing traders from managing their positions. Thousands of traders reported order-rejected errors while watching their collateral evaporate. It was a perfect storm of technical failure and market panic. In a desperate attempt to contain the damage, Binance triggered its auto-deleveraging ADL system, a last resort mechanism that forcibly closes profitable positions to cover the losses of liquidated traders. This is a controversial feature as it penalizes successful traders for the failures of others. In traditional finance, clearing members absorb defaults. In crypto, that role doesn't exist, and ADL serves as an algorithmic clearing member of last resort. The fact that Binance had to resort to ADL despite having over $1 billion in its reserve fund raised serious questions about the exchange's risk management practices and whether the ADL system was triggered by price thresholds rather than actual fund depletion. The October 10th crash was a brutal lesson in the fragility of the crypto market's infrastructure. It exposed the dangers of centralized exchanges, the risks of over-leverage, and the potential for a single piece of news to trigger a catastrophic chain reaction. It was a purge of excess, a violent cleansing of the market that shook the confidence of even the most seasoned investors. On the hyperliquid exchange alone, over 6,300 wallets were pushed underwater, with more than $1.2 billion in capital lost. The event sparked intense debate about the structural weaknesses in crypto market infrastructure and the need for better risk management systems. In the aftermath of the crash, the market was left to pick up the pieces. Bitcoin eventually stabilized around the $103,000 level and then slowly began to recover, ending the month at around $115,000, down about 4% for the month. Ethereum followed a similar trajectory, ending the month down about 6% at approximately $3,847. The altcoin market was a sea of red, with many smaller tokens down 20 to 40% in a single day. The infrastructure application leaders index fell 10.88%. The smart contract leaders index dropped 11.51%, DeFi leaders plummeted 21.84%, and meme coins crashed 18.24%. So, what does this all mean for you, the investor? If you had invested $100 in Bitcoin at its peak in early October at $126,000, you would have seen your investment drop to as low as $82.50 during the crash. Even with the subsequent recovery, you would have ended the month with about $91, a 9% loss. The lesson here is clear. Chasing all-time highs in a euphoric market is a recipe for disaster. The importance of risk management, of not using excessive leverage, and of having a long-term perspective cannot be overstated. This event perfectly illustrates why professional traders always emphasize position sizing, stop-loss discipline, and the dangers of FOMO-driven trading. Looking back at September and October 2025, we see a market in transition. September was a month of divergence and underlying weakness, a prelude to the storm that was to come. The flight to Bitcoin as a safe haven, the decline in altcoin performance, and the reduction in blockchain revenues all pointed to a market losing momentum. October was a month of crisis, a stress test that the market ultimately failed. But it was also a month of cleansing, a necessary purge of the excess and froth that had built up in the system. The leverage that had accumulated during the euphoric rise to $126,000 was violently flushed out, and the market was forced to confront its structural weaknesses. As we stand here at the end of 2025, with Bitcoin trading at around $87,000, it's clear that the market is still healing from the wounds of October. The total crypto market cap is now around $3 trillion, with Bitcoin dominance at a healthy 57%. The fear and panic of October have subsided, but the memory of the crash still looms large. The events of September and October have provided us with invaluable lessons about the nature of the crypto market, its vulnerabilities, and its resilience. We've learned that centralized exchanges remain single points of failure, that over-leverage can amplify losses catastrophically, and that macro events can trigger chain reactions in interconnected systems. The October crash also highlighted the need for better infrastructure. Questions remain about whether Binance will diversify its Oracle sources, improve engine uptime under load, and whether professional traders will migrate toward exchanges that stayed online during the crisis, such as hyperliquid or traditional venues like CME. The event has sparked important conversations about the need for clearing members in crypto, similar to those in traditional finance, who can absorb shocks and prevent the kind of forced winner liquidations we witnessed. As we move into 2026, it is these lessons that will guide us in navigating the ever-changing and always exciting world of digital assets. The market has demonstrated both its fragility and its resilience. Bitcoin's ability to recover from $104,000 to $115,000 by month end, and the fact that the system continued to function despite the stress, shows that the underlying infrastructure, while imperfect, is improving. The purge of leverage may actually set the stage for a healthier rally in the future, as markets built on excessive speculation rarely sustain long-term growth. For those of you who are serious about succeeding in this market, remember these key takeaways. First, never chase all-time highs with leverage positions. Second, understand that September is historically a weak month for crypto, and position accordingly. Third, recognize that centralized exchanges carry counterparty risk, and diversification across venues is prudent. Fourth, macro events matter more than ever as crypto becomes increasingly correlated with traditional markets. And finally, the best opportunities often emerge after capitulation events like we saw on October 10th, when weak hands are shaken out and the market can rebuild on a more solid foundation. And thank you for joining me on this journey through the recent history of the crypto market. I'm Boni, and this is Boni's Life. If you found this analysis valuable, please hit that subscribe button, leave a comment with your thoughts on September and October, and share this video with anyone who needs to understand what really happened during these critical months. I'll see you in the next episode, where we'll continue our year-end review series. Until then, trade smart, manage your risk, and never stop learning.